Hey, folks. Looks like we're getting good attendance today. So welcome to, I think this is like my 6th episode of Instant Payments Decoded. And we have a fun topic today, stablecoins, super hot, hotter than AI right now. So glad to have you all with us. And I'm sure there'll be more people joining as we go. When you guys join, you're on mute and off camera. So what I would recommend doing, we'd love it, the dialogue to be interactive. So we have a Q&A box and a chat box. So if you have questions, just put them in there and we may take you off camera, put you on camera, and so let's have fun. So just to kick us off, did you know that Visa processed more than $225 million in stablecoin in transactions? And while most of the banks stayed on the sidelines, right? Or that stablecoins can settle across borders in under 15 seconds with no SWIFT code, no delays, no weekend downtime. So welcome to Instant Payments Decoded. I'm your host, Marcia Klingensmith, the Instant Payments Maven. And today we're diving into a big question that's facing institutions everywhere, right? Stablecoin, FedNow, CBDC, what should we be using and when? And so to help us just decode this, I'm joined by 3 phenomenal guests. We have Larry Pruss of SRM, who advises credit unions and banks on crypto strategy. We have Becky Reed, who's the CEO of BankSocial, who's built real-world stablecoin use cases from the ground up. And we have RJ Van Ooyen of Icon Solutions, who's advising global banks on programmable payments and multi-rail infrastructure and designing the next generation of multi-rail solutions. So let's get into it. So just because not everybody really understands what stablecoin is, Larry, why don't you help us with the basics? Break down what stablecoin is, and more importantly, what it is not.
All right, I'll give a shot at it, and Becky, I'm sure you can help as well if I miss something. So, I look at stablecoins as kind of a derivative of the dollar. It's almost like an electronic dollar. So if you were to take electronic dollars or even physical checks and turn it into an electronic version, that's kind of what stablecoins are. They're backed 1-for-1 with US dollars, at least per the recently passed Genius Act. They've got to be redeemable within 3 days. They have to be audited on a regular basis. The backing on a 1-for-1 basis typically is cash or short-term treasuries. They're used a lot in the crypto world. That's where they got their start, as people wanted to settle in crypto and kind of move in and out of trades to something less volatile. For those of you that know crypto and think of something like a Bitcoin or Ethereum, while they kind of had the idea early on that the crypto punks of they kind of wanted to use it in everyday payments, that really wasn't possible because of volatility of those crypto assets. So stable coins are backed 1-for-1 by dollars and sometimes other assets that makes them perfect for settlement, for payments, for cross-border transactions, for trade finance. So they're starting to find their niche in the broader payments ecosystem, and a lot of banks and credit unions kind of trying to understand what are the use cases, are they coming for interchange, where these things are headed. So that's a quick background on what stablecoins are, what they aren't. Maybe I'll let someone else take a shot at that. Becky, maybe RJ, you guys want to fill in anywhere I might have missed?
So stablecoins aren't the same as RTP and FedNow. Stablecoin is not the same as ACH. Stablecoin is not the same as a point of sale ATM transaction. But the reason they're not the same is they ride on different rails. Not because the consumer or the customer experience is really that much different. So I think that what I talk to financial institutions about all the time is what we do at a credit union or at a bank is we do payments. That's what we do. Even a loan at the end of the day is a payment, right? We're letting somebody borrow money so they can go pay somebody else. right? To buy a car or a house or, using a credit card or whatever it is. And so we as financial institutions are the mechanism by which our customers or members live their lives. Their paycheck goes into the institution and they pay other people through a variety of different mechanisms. And so when I talk to boards, a lot of times people say, this crypto thing is so confusing. I don't understand blockchain rails. I don't get it. And I'm like, you don't have to get it, because could you explain how an ACH works today? No, and neither could your board. Now, your accounting people in the back office probably can explain it, but you can't, your board can't, certainly the end user customer cannot. So it's really just what we've always done that ends up being better, faster, cheaper, and more secure.
Becky, can I add something? I'm sure RJ wants to add too. One of the big things about stable coins is they're instant, they settle 24/7, but there are no real intermediaries. And so if you think about every other payment process that's out there, there's usually 4 to 6 intermediaries, trusted intermediaries that are there to make that transaction happen. Stablecoins, all you need is a sending wallet and a receiving wallet, and you can move money anywhere in the world. And so the one thing I've been telling folks when I do board presentations and executive level conversations is this is very much like kind of the game of musical chairs when you were a kid. Like it doesn't really matter that you grab the first chair, but you don't want to be the last one grabbing the chair, because someone is going to get cut out from an intermediary standpoint. We just don't need as many intermediaries because of technology. And that's something that people really need to understand about stablecoins, and to maybe a lesser degree, tokenized deposits. Now that's something very different. We can talk about maybe what that is a little bit later. But RJ, did you want to add anything?
Yeah, well, I fully agree with what you said. Stablecoins, there is quite a lot of similarity with CBDCs and tokenized deposits in the way that it's a digital registration of fiat money, as you already said, meaning also it's not newly created money. It's another appearance of money that is must be backed up by fiat money that is deposited somewhere. And the key difference between CBDCs, tokenized deposits, and stablecoins is that is the issuer behind it. In case of CBDCs, it's a central bank that's issuing, meaning also you deposit your money with the central bank in return for then the digital currency that you receive. In case of tokenized deposits, it's a commercial bank that sits behind it, who's issuing it, meaning you put your deposit with that bank, and then in return you get the digital currency that you then can use to transfer money around. In case of a stablecoin, it's a non-bank that issuing it. So if you take, for instance, USDC, which is the second largest stablecoin that's currently in circulation, it's the company Circle, which is a non-bank which sits behind it, but they have deposited, or they have deposited all the funds, the fiat money that they received in return for the circulation of the digital currencies in bank accounts or in short-running bonds, so that they are always capable of having the fiat money in order to redeem the digital currency or the stablecoin back into fiat money when this is required by the person or organization that holds the stablecoin.
RJ, one thing
I was going to say, I want to do a little poll. I mean, I think we've given a great background on what stablecoin is. You guys have done a great job of like articulating this and putting it in terms that like folks can understand. I want to kind of gauge, like we've got a lot of people attending the call today. So I'm launching this poll here, like what is your stablecoin IQ? So want to have an understanding of like the audience that have come today, like, what is your understanding of a stablecoin? Are you still at the, what the heck is this thing? Or, I get the concept, not sure how it applies. Or maybe you're more forward thinking, like we're exploring use cases, or maybe you're actually live. So you should see a little pop. And then looks like there's some questions coming up. There's a little pop, so look for the poll. It's either going to be on your main screen, or if you don't see it on your main screen, look for it in your chat channel. So we want to see your results there. So it looks like we might have a question already rolling in. The question we're rolling around today was for consumer transfers using stablecoin. What is the dispute process? It looks like Larry Larry wants to give it a shot.
So stable coins are basically bearer instruments. So just like almost like a FedNow type of payment, they're instant and they're irrevocable, meaning you can't reverse them. That said, there are people out there in the industry who are looking at building some solutions that would feel very much like a dispute process. Becky looks like she might have a solution there. So while they don't exist today that I'm aware of, there's a lot of people ready to bring it to market.
Well, and actually, this is a good segue. I mean, Becky, I love that you kind of built this BankSocial platform that's targeted at the smaller financial institutions, because it always feels like they miss out. So maybe you could give us like a little peep into like what you're doing. How do your customers interact with stablecoin?
So we have an embeddable digital asset wallet that goes right into your digital banking product, where members can buy, sell, send, and receive digital assets. That's all kinds of digital assets. That could be NFTs, that could be stablecoin, that could be cryptocurrencies that you might have heard of that Larry just mentioned, which would be Bitcoin and Ethereum. So giving the members access to the blockchain rails, distributed ledger technology, or DLT, is a generic term for a distributed ledger. Blockchain is a specific type of distributed ledger that is most notably connected with Bitcoin specifically, but there are thousands of distributed ledger chains, and all of them have different functionality from a programmability perspective. So when RJ was talking about, or Marcia was talking about RJ with programmable money, that's exactly what blockchain technology brings. It's a digitally native technology that allows you to program the cryptocurrency that rides on those particular rails. So when Larry was talking about a stablecoin, which RJ is 100% correct, that is a non-bank issuer. So it's issued by a non-bank, could be a CUSO. We happen to be a CUSO. We have a stablecoin. So we issue the stablecoin. The dollars backing the stablecoin are put into U.S. financial institutions, credit unions at this point, 100%. So to the credit union, it's just a business account deposit. Okay. It is our responsibility as the issuer to make sure that we're complying with the Genius Act, to make sure that the dollars backing it are always available, so that when somebody wants to turn it back into a fiat currency, we can give the dollar back. But being programmable means that there are things that you can put into a stablecoin. There are certainly publicly issued stablecoins like USDC or USDT, which are the two most popular in the world right now. USDT is more popular globally. USDC is more popular domestically. But there are also, and there's rules that have to be made available to those. Right now, USDT and USDC is not clawbackable, okay? It's a final transaction at the end of the day. The transaction is final once it gets sent. However, because of the programmability on a variety of different chains in which you build your stablecoin on, you can have a private network that's not a public network, like Ethereum or blockchain. You could have a private network, for example, that is just credit unions. So think about Zelle, right? Zelle was a bunch of banks came together and they had a network between themselves where they could move money back and forth, right? And you had to pay money to be part of that network. You could create a private network where you build a stablecoin that does have the ability to freeze, that does have the ability to be brought back, that does have the ability to add KYC data and information to it that does have the ability to be programmed in such a way that it can only be used for certain things or certain use cases. So a publicly issued stablecoin has a certain kind of functionality. A privately issued stablecoin could have much more functionality based on the network on which it is built and for whom.
Love it. Love it. I know we have a lot of ground to cover. And but before we dive into the polls, which talk a little bit about use cases, because I see like half of the folks are already working on use cases, which I find pretty exciting. I want like RJ to talk a little bit about the risks, because we're talking about all the, the benefits to using stablecoin already, and that was some great insights. But let's kind of flip the coin here and talk a little bit about the other side. RJ, can you kind of share some insights?
You mean on the risks
on the
general?
risk side of things?
Yeah.
Yes. Mm-hmm.
So of course, I think risk you can divide in a couple of areas. First, the technology risk. I think that is very much limited because it's based on open source technology, which is very solid. And the way these networks work is that the whole processing is distributed across multiple what they call nodes, which are controlling each other. And it also means when one of the nodes falls out because of a technical failure or is being hacked, that is discovered by the other nodes, meaning that by hacking one of the nodes, you can't hack the system as such, which is, of course, different when you have one single solution with one single database, let's say, and when that is hacked, then, of course, you run much bigger risk. So I think from a technology perspective, security perspective, and all these kind of things, it's a very sound technology. Then you have more the financial risk, as I mentioned, and there's, of course, with stablecoins, the organization that's issuing the stablecoin, you need to be sure that at the end of the day, when you're going to redeem your digital currency or your stablecoins, and you want to get in return back for fiat money, you need to be sure that that company still has that fiat money available.
Yeah.
And we're talking about organizations that are not under the oversight of central banks, as we are familiar with in commercial banks. So I think there's a lot still that needs to happen to get that trust. Tether was already mentioned as an organization. I think from a trust perspective, I would be more reluctant. Circle, I think, has done a much better job so far, and also reports every month or every quarter what they have done with the deposits, where they have the deposits, how much is on bank accounts, how much is in short bonds, so that they can quickly exchange that into fiat money, so that they can comply to the obligations for being able to redeem the stablecoin.
RJ, there's a nuance here that's probably worth mentioning. So with stablecoins, they're backed 1-for-1, which is essentially full reserve or flat banking. Obviously, as everyone on the phone probably realizes, what we have from a banking system is fractional reserve banking. In the US right now, post-COVID, our reserve requirements are essentially zero. So from a stability standpoint and a risk standpoint, there is some advantages of stablecoins, but it does tie up liquidity and capital formation in the economy. So that could become a big issue, but it also provides a big buyer of U.S. Treasury. So because these things are backed by U.S. Treasuries, Circle and Tether, and a couple of large other issuers, if you were to look at them as one entity, they're the fourth largest holder of U.S. Treasuries in the world. So, you have to understand there is a very big difference between how these things are backed. Stablecoins are a lot more like a money market fund in that they are backed by treasuries. They're not backed on a fractional reserve basis. They tend to be on permissionless public blockchains, as opposed to maybe a tokenized deposit or consortium coin, which would be on a private permission blockchain. So there are some nuances there, but I think we've captured a good portion of it so far.
Yeah, and I would say like not all stable coins are created equal, to your point. Like if they're backed with different kinds of things, some have,
Yeah.
legitimate USD assets,
Well,
but then some are even using like the Bitcoin to back them. And
it,
so this
in
is
the
an area that I guess if you're dabbling in stable coins, you need to be aware that, it's like it's back in the Wild West days, like literally in the US, but like in the 1800s when they were issuing banknotes, the banks were issuing banknotes, and some of them actually had gold coin behind the banknotes. But some of them were using like property and all sorts of things. So when people tried to bring their banknotes and get gold coin, there wasn't always enough money behind the scenes. And so we're kind of seeing the same thing with stablecoin, right?
Marcy, the important thing that the Genius Act does, though, at least in the U.S., is stable coins now are required to be backed one for one by U.S. dollars. So you may have international ones that are a little bit different, but in the U.S., if you want to use the term stable coin, you have to be fully reserved, back one for one, monthly attestations, redeemable within 3 days. So there is no question from a legal standpoint anymore what that means, and that opens up a whole world of use cases for stable coins that didn't exist previously. Because you think about like a merchant, why would you ever accept a stable coin if you couldn't take someone to jail if it wasn't really backed one for one? Well, now it's backed one for one, and we're starting to see the likes of an Amazon or Target that are starting to look at these things and go, I wonder if there's a different, faster, easier, cheaper way to do payments.
So actually, this is a good place to I want to ping, like, as I know there was like 55% of our audience that said, hey, we are already testing out use cases, and 5% were already live. So if you guys wouldn't mind, we'd love to see your use cases. Maybe just put it in the chat, because I know we do have a lot of content we're going to go through. And so while you guys are putting your stuff in the chat, why don't we just start exploring a little bit about those? Well, so I have because the next thing I wanted to cover is when you use what. I guess, can we just have a couple more words on before we dive into the use cases, like how do you think about when to use RTP versus stablecoin versus CBDC?
Or did you want to answer that?
Yes. Who did I have that? I don't know. Becky, you want to start?
Sure. Why not? Well, RTP and FedNow certainly are an option as long as the financial institution that is receiving or sending the money is a participant in that network, right? And of course, anything that is connected to DLT rails, i.e. a stablecoin, even a tokenized deposit, needs to be connected to the financial institution needs to be connected to those rails in order for their customers or their members to be able to use it. Of course, a central bank digital currency is probably going to be used mostly for settlements, right, between financial institutions. Yep. And so I think that depending on what it is your customer is trying to accomplish, and the best way to accomplish that is how the future of payments is going to work, right? So you have this intelligent routing payments hub, which just happens to be what we have here at BankSocial, but it's going to route the payment the best way, that maybe the least expensive way that it makes sense for that customer, the way they want to send it. So the way that would work is your member says, I want to send something to Larry, and it's going to ask me, the member, when does Larry need it? Okay, he needs it in an hour. Okay, are you willing to pay $3 for that transaction? Yes. Oh, Larry's financial institution happens to be a FedNow financial institution, and my financial institution is a FedNow institution for send. Now I can move the money through that rails. Maybe that's the quickest, easiest, cheapest way to do that. Now, a FedNow send costs about 4 cents, right? 4.5 cents. So now the credit union marked that up to $3. They're making the revenue on that. Well, a stablecoin transaction, use that as another example. A stablecoin transaction, maybe they're part of the same network. That transaction might cost sub pennies, right? So it might cost 0.001 cent in order to send that transaction. Let's say that transaction costs $1.50, and so and it settles immediately and it happens that way. So, you know, it just kind of depends on the network that they're in, how much the transaction costs, and if you have the capability behind the scenes to route it the best way.
I love that. And then RJ, I know you've worked with a lot of tier one financial institutions that are already doing kind of like these cross-border transactions as well. Can you talk a little bit about what you're seeing, how the bigger financial institutions are architecting their flows?
Yeah, from a use case perspective, continuing what Becky already said, she gave the advantages from an charging or fees perspective. But there's another advantage of a DLT technology is that it's built to be integrated. And that means that, for instance, you can start creating, and that's also part of the programmability of it. You can start creating payment type of instruments where, for instance, I need to pay the supplier, but I'm only going to pay if I have received the goods in the agreed quality and quantity. On the other hand, the supplier wants to know that you're going to pay, meaning that then you can put the money on the DLT network in a contract where those conditions are programmed. And then if you have a separate supply chain management environment, which can a DLT network, which can be another kind of digital registration, where the physical transport of the goods and, for instance, also an inspection report is created. And if that then has been completed and has reached a stage, yes, the supplier has met his obligations, then that platform can then send a request to the DLT platform to state, yes, it has met the conditions. Now you can automatically transfer the funds to the creditor's account. And in that way, this is what we also know as letters of credit, bank payment obligations, bank guarantees in that space, where you can start leveraging the programmability and the integration capabilities of DLT technology to facilitate these value-added payment services. And that's also where, a lot of the value add potential is.
I love this, and that's going to tee up a conversation we're going to have in just a minute. But I noticed that there's a question coming in about the pros and cons of tokenized deposits over stablecoins, and also, Larry, I was going to ask you a little bit about liquidity. So I don't know if you want to tackle, talk a little bit about the tokenized deposits, and then maybe the liquidity required, because RTP and FedNow, you have to have a certain amount of money in reserve. With stablecoins, you also have to have a certain amount of money in reserve. So I don't know if they're not exactly the same question, but maybe you want to tackle the two of them in a little.
Yeah, so internationally, stablecoins can be a bit of a drag on a bank's balance sheets because Basel has some pretty significant capital requirements. That's not the case for tokenized deposits, because tokenized deposits are basically digital representations of existing deposits. You've got the same capital requirements you would with any other deposit. One of the big advantages of tokenized deposits is they can pass interest back to the customer or member. That's not the case per the Genius Act of stablecoins. Now, that doesn't mean you couldn't pass a reward back to the customer. So there are similar benefits of both tokenized deposits and stablecoins in that the users of those could end up gaining some sort of reward. Likewise, if these things ever made it into kind of everyday payments, the merchants could provide a reward for either holding those stablecoins and or using them at point of sale. So they both have different pluses and minuses. One of the other big pluses from a bank or credit union standpoint of a tokenized deposit would be the control you have over that instrument. They tend to be over permissioned non-public blockchains, which also adds a degree of privacy, which is pretty important. We may get to a world where people don't care that much about their privacy anymore because we've kind of given that up with having the digital footprints that we do. But banking transactions or credit union transactions are one area where privacy is still very important. That's a particular advantage that tokenized deposits have over stablecoins. At the end of the day, I think we'll see both of them exist as different kind of instruments for some period of time. It's hard to say which one will end up winning out, but I would look at both of those as potential competition to the existing payment mechanisms that are out there today. And again, going back to that analogy of musical chairs when you were a kid, you don't want to be the last one when the music stops playing to not have a chair in your hand.
Awesome. I'm going to take a quick break again for a poll here. I'm going to launch one. This one is just like, because stablecoin can address so many different areas. This poll is talking about, here it comes. Again, look for it either in a pop on the front or in shout on the side. You know, this is talking about your gaps. Like, you know, does your financial, well, we didn't take an assessment on where folks are coming from, but do you have a need to address cross-border payments, payouts, or maybe, you know, 24/7 Treasury tools, or small business or consumer disbursements or embedded payments? Like, these are all potential use cases where you could see, you know, some use of stablecoins. So why don't we, like, while folks are responding to that, let's start talking about real world use cases, because I think this is what everybody wants to know. Is like, where do these things actually get applied? And so, Becky, why don't you start and just talk about a few of the use cases that you've already deployed? Like, how are you using a stablecoin today?
So one of the things that Larry was talking about is interoperability. And that's one of, I think, the key things when we're talking about distributed ledger technology is there is interoperability between chains and between tokens. So I think that what we're going to see is we're going to see an explosion of stablecoins, which are a non-bank issuer, right? We're going to see tokenized deposits. The Genius Act calls stablecoin or a payment token, right? A tokenized deposit might be called something different. I guess a tokenized deposit. I don't think the Genius Act didn't address that specifically, but there's different ways that you would do that. I saw something in the chat about, well, you know, Target and Walmart and all these people start issuing it, and there's some things in the Genius Act that are going to stop some of these mega companies issuing these things, but they'll just own a private stablecoin issuer probably to do it for them. But there's going to be all of these, right? So there's going to be a JP Morgan token. There's going to be, you know, maybe there'll be a credit union token. You know, maybe there'll be a whatever kind of token out there, both public and public and private permission, right? So there's got to be a mechanism by which your member, whatever it is that they're using, whether it's a tokenized deposit or a stable coin or something that, you know, they bought Bitcoin that they're turning into a stable coin for payment at Steak and Shake, because Steak and Shake takes Bitcoin for payments. So, and Starbucks does too. So there's got to be that interoperability where all of these are going to be able to be
Do you want to talk a little bit more about, like, because I know the cool thing is you actually have something for credit unions. Do you want to highlight a little bit about what that is and that experience? Or
sure. So the Rivia stablecoin is a privately issued stablecoin. It's issued by Rivia Inc., which is wholly owned by BankSocial, where the deposits backing the stablecoin are in United States credit unions. And it's 100 one-to-one back. There's no U.S. Treasuries or anything. It's purely just a dollar for dollar deposit sitting in U.S. credit unions, which are able to use that deposit like they would any other deposit. These are consumer-facing tokens that people can buy on an exchange. They're available on the BankSocial exchange. But today they're being used for a couple of different things. They're being used as rewards, like Larry said. So there is a DAO out there, a decentralized autonomous organization, and that DAO is paying its token holders in Rivia stablecoin. So that's how they get their rewards, their staking rewards for the token. So that's one way that it is being used. It can be used as a private network. We're talking to about 4 or 5 different credit unions to do a pilot for a private permission network for the Rivia stablecoin to be used in between credit unions. What we found is when credit unions looked at their data, they pulled their data and they saw how many transactions are going out to other credit unions every month. And it's a lot of loan payments are actually, because, you know, I have 3 different credit union accounts. I have a loan at one and I have my checking account at the other, and I'm moving money back and forth all the time. Well, just an ACH transaction, first of all, don't, you know, think about, we're probably not thinking about the back office cost of processing payments, which is actually enormous. But that cost, so there's operating costs to doing an ACH, but the ACH itself costs a couple of pennies. Well, the stablecoin, our stablecoin, costs 0.007. So if the credit union can move that stablecoin back and forth between the credit union, they not only save themselves a lot of money from the transaction cost perspective, but also from the back office processing cost. ACH, you have to look at reports for things that kick out. It's a, you know, it's a batch process that you have to post 2 or 3 times a day. It's just a painful, clunky process. And that's not even talking about the fraud that happens on ACH. So using a distributed ledger, and everybody's talked about it, RJ and Larry as well, that programmability also provides traceability that is just not available on any other payment network today. So better, faster, cheaper, more secure is something that the Rivia stablecoin or any privately issued stablecoin or public, depending on the use case, can provide.
Well, like a closed loop network, but it can help really help banks, especially smaller banks that might be struggling or have gain a competitive advantage. Love that. And then Larry, I think because I want all of you kind of to share from your perspective, because I know there's some pretty interesting use cases. Larry, do you have like maybe a use case or two that you can share?
Yeah. So again, I'm looking a little bit more into the future. I'd say the use case is anything that you would use cash or checks today for. Potentially anything you'd use credit cards. And one of the things holding that back, and Becky just alluded to that, is interoperability. If you think about consumer checks, you know, we have no problem accepting consumer checks from another bank or another credit union. Why is that? It's because there's a clearinghouse that exists that ensures those clear. Well, guess what? There's now stablecoin clearinghouses that exist, and people who are thinking about that from a trade association standpoint and building these things where anyone part of that clearinghouse would be able to accept each other's stablecoins at par. And that's going to become a really big deal. So that provides a kind of ubiquity that we would need for you to kind of gain acceptance. Now, that very much depends on network effects. But so far, just based on the excitement around this concept, I would say that those network effects are likely going to be achieved.
Awesome. And then RJ, like I know we were talking about the Panama Canal. Why don't you share some of your use cases that you're seeing?
Yeah, maybe there's a very peculiar case that, or a project that I did, a pilot in Nigeria. And that was related to the distribution of medicines, where the health center using medicines were ordering this at the distribution center, and when they were collecting the medicines, they had to pay at the moment of collecting, meaning that the truck driver had a check endorsed by 5 people because to avoid any fraud and so on. So it was a very cumbersome process. And that also means that the check after that needs to be collected with, again, the associated risks. So we created a DLT network based on Stellar, where we registered a digital Naira, which was backed up by one of the commercial banks in Nigeria. And then we created a mobile app that both people in the distribution center as well as in the as the truck driver had to confirm the physical handover of the medicines. If those confirmations had both been done, then it automatically triggered a transfer to transfer the digital Naira, which was in the account of the hospital center on the DLT network, on the Stellar network, directly into the account of the distribution center. after which the distribution center could redeem it back again with the issuing bank for fiat money to be deposited on the bank account of the distribution center. And that means that it's much more efficient, it's faster, but you have taken out a lot of risk in terms from a fraud perspective and so on, risk of losing the check, whatever. So, and that was a quite successful pilot that we did.
And that sounds like it would have like really good applicability for like emergency relief situations, like a tornado or something comes in, and
FEMA,
like this could be a
about
really
FEMA.
great way to disperse goods into a country.
Yes, absolutely. And the other advantage is that you can mark the money on the DLT network to be used for a specific purpose. So if if there is a hurricane and you want to give people money for restoring houses or whatever, but you want to be sure that that money then also is spent for that, meaning that you mark that money, those stablecoins for that purpose, meaning that it can only be transferred into accounts of designated parties to do the restoration work. So also that in that case, you kind of start preventing that money that is intended for a certain purpose is being spent on other things than what it's intended for.
I love that. I think that's really valuable. And I was actually just thinking about instant payments and how like there's the ISO 20022 fields where you can put some designation that this needs to go to, you know, some relief committee. And I guess in theory, you can program rules to say, hey, look at this field and prioritize this payment, which is actually kind of one. So well, taking a slight tangent, right? Like now that everybody's finished their ISO 20022 compliance, there's now the opportunity to build these kind of rules in. So the value that you're getting with stablecoin, I guess, like it's really exciting, all the things that we're talking about here. And you know, in theory, we can also do these things with our existing rails, especially now that we have ISO 20022 as kind of the standardized language. So I don't want to say here that I'm an advocate for switching all over to stablecoin. You know, this is just kind of more of a tool for kind of, you know, educating ourselves and exploring possibilities. So I think we're really at this interesting juncture when these opportunities are cropping up. I think we are still doing pretty good. I think there's a couple questions that come, and then so why don't we look at a question or two, and then we're going to do like a lightning round on some what I considered kind of like hot topics on stablecoins. So I think we have, okay, was it, okay, where did it go? I saw something. There's a little bit of, time sensitive. Any time sensitive disbursement? Oh wait, that's okay. Okay, maybe I know. I thought there was a question there. I'm not seeing a question. If you had the question, maybe you could repost it or put up your hand. Okay.
Marcia, there were a couple questions I had answered in the chat. So
oh, okay. You've been taking care of them as they go. Awesome. Perfect. Perfect. Okay. Okay. So we get 30 to 45 seconds. You guys got to do a quick answer on these ones. So we're going to just do round robin. Okay. So do you guys see stablecoin as the instant path to the future, or is this just like one of many rails? Because it's super hot right now. I don't know. RJ, you go first this round.
Yeah, I don't think it will be one. What you see typically happening in the market in general, the payments industry, enormous growth in different options to do payments, but also clear and settle payments, and that will grow in the near future. And then yes, it will increase competition, which I think in the payments market is not a luxury, considering that, especially in the cards world, where it's dominated by two players mainly. So and the
competition will rise. So you don't have like, there's not like, it isn't coming out as the top winner yet. There's
No, but also it will put pressure on fees for end consumers, fees to be paid by merchants. And I think that's a good thing for society in general. Yeah.
All right, Becky, you're up.
I think that, like I said before, there's going to be an explosion with stablecoins and tokenized deposits while everybody tries to, frankly, win in the space. I don't think there will be one winner. I think there will be a bunch of people trying to get in there, and I think it will consolidate down just like we see in any other new entrant to the market. I also think that it will live alongside of FedNow and RTP and ACH and credit card and debit card rails for a period of time. So I think that period of time is at minimum the next 5 years. It could be the next decade. So it's not going, I mean, we still write checks, guys. We still write checks. So it's not like all of these other things are just going to go away overnight. But what I preach to financial institutions is get connected to DLT rails now so you can take advantage of it.
Awesome. Love it. Larry?
I'm going to say ditto, but I'll add, I would say it's going to be just another rail, but something that settles 27 trillion today, ignore it at your own peril. That's what I would say.
All right. Okay, so here's one thing that's driving me crazy is, you know, a lot of banks got out of correspondent banking because they can't control like the last mile of payment transactions. And I don't see how stablecoin can solve this. And I don't remember if it was an article or if it was somebody I was talking to, and they were talking about, you know, this guy in the Philippines that just went up to a kiosk and got their $50,000 of cash just by showing their little stablecoin digit. And obviously that doesn't work for US banks. And so I'm sure there's ways to manage that, you know, maybe closed loop network or whatever. But like, what is your perspective on how either how it's being done today or how you think it should be done? And I will start with Larry.
So something important to recognize about stablecoins and digital assets in general, while people like to talk about money laundering and terrorist financing, it's less than 0.5%. If you look at cash usage, U.S. cash usage, it's about 8% of its used for nefarious purposes. So we have cash today. We can't control where that is used. There is plenty last mile examples of other sort of payment solutions. Stable coins will have that same problem, but that doesn't mean that they're not useful.
Okay, RJ?
Well, I do see stablecoins as a big change in international payments, clearing and settlement of international payments, and at the end of the day, also going to mean the end of correspondent banking as we know it. So there will be networks where, and that won't be one network, but maybe quite many. And then banks will participate in one or more of those networks in order to use the stable coins to transfer money from one institution to another institution. Meaning that it doesn't necessarily need to be that the end customer is directly connected to or making use of the DLT network, but the payment service provider it makes use of, whether it's a bank or it's a non-bank payment service provider. But it makes it much simpler for clearing and settling these kind of international payments.
So keep it contained to the financial institutions where you know the end point, the start point and the end point.
Yeah, but it could, like I said, it can also be fintech companies which don't have a banking license, maybe a payment service provider license. But that means that it's much easier to reach and to get
safely
money from one end to the other. Without the complexity of the correspondent banking world as we know it at the moment.
Okay. Becky?
I think one of the first things that is going to fall with stablecoin, and it can be CBDC, tokenized deposits, any of those kind of digital dollar digital assets that are moving on a DLT. I think SWIFT is probably a place that is going to be disrupted the most and the quickest, because anybody who works in a financial institution understands how challenging that whole process is. And when you look at the programmability and the capability of tracing funds all the way to the end user who is using it with a digital asset, that's unprecedented in any TradFi rail that we use today. So I think that will be the first to fall. But developers are going to start building more stuff in this space now that it's becoming regulated, now that regulated financial institutions are going to use it. I saw a question in there earlier, and I'll answer quickly. But they're like, if you don't need an intermediary, like Larry said, which is 100% true, I can transfer a digital asset to myself, to Larry right now, this second. It'll take 2 seconds. I don't need a bank to do that, right? I can be 100% unbanked. He can be 100% unbanked. As long as we're connected to the internet, we can interact between each other. However, why do we need financial institutions? Because of consumer protection. So I can make that transaction with Larry, and if he has scammed me and he has lied to me and he promised to sell me something that he didn't give to me for transferring that asset, I have zero protection. I have zero protection. He can also be a company and promise me 25% interest on $500 that I give him. I have zero protection if he doesn't provide that to me. And so we need regulated financial institutions to be in the middle of this, to provide that consumer protection for people who are using payments every day.
Well, and I guess that traceability, the transparency, the ability to audit the trail when a bad actor is there. I guess it's kind of like when you think about biometrics, the bad actors hate to get their video or their photo taken, because that's a lot harder to dispute when they do their fraudulent activity. So I guess that's the idea with the stablecoin, is like, you've got the ledger activity, you've got proof that they were involved with that transaction, so you can use that to come back to them. And then so we talked a little bit. We mentioned SWIFT. Does anyone in the group have thoughts on the orchestration? What will the new world of payment usage look like? I think we talked a little bit about that, like a single API. I think Becky, you had mentioned, with kind of like all the payment options kind of coming off of that and being orchestrated based on best use case.
Right.
One of the things we talked about, we talked about the assets that back it. And in the US, we talked about there has to be, one for one, but stablecoins are really global in nature and they're cross-border. How should the folks on this call be thinking about, I guess, the asset, that asset backing element? Like, do they only work with certain stablecoins, or like, what does that mean?
I mean, if you're going to be a stablecoin issuer and you want to interact with anyone in the U.S., you're going to have to fall under the regulatory regime, which requires one-for-one backing. So Tether is the big one that people tend to question. Tether has already made it kind of very public that they are going to work with the current administration to come to the level of compliance they need to. So given that Tether and Circle probably I don't know what the exact number is, but probably 90% or more of the market, the likelihood of you having to deal with any other stable coins that are outside the U.S. regulatory rule of law is going to be probably slim to none in the near future. They just won't exist. I mean, there's going to be ones that are maybe tied to privacy and more used for illicit type transactions, but they're going to be a very small use case basket.
And I have one hot question, kind of like this is like an alternate payment network, and we talked about disruption and stuff like that. Do you guys think this stuff is going to threaten monetary stability? Is that, how is this going to, because there's a certain amount of liquidity that has to be committed to this network. And when this liquidity is committed to this stablecoin network, it is not in the mainstream financial system. So, what are your perspectives on that?
It kind of depends, because if you think about them as a buyer of U.S. Treasuries, and we need U.S. Treasuries to fund the fiscal irresponsibility of the U.S. government, stable coins could very much be a solution that prevents kind of a fiscal collapse. You could also make an argument it does tie up liquidity, again, to the extent that deposits will flow to a stable coin in the event we have a disruption like another Silicon Valley bank. That could be a big issue. But again, the benefits of having them another buyer of treasuries probably, or at least based on the fact they just passed the Genius Act, probably is more important than the financial stability that they might risk to the current system. But again, that's just my opinion.
So I'll
And
chime in.
I agree
Go
with
ahead,
that.
Arden.
Yeah, what Larry already said about Genius Act, I think that's very clear about the backing of the issued stablecoins by fiat money, meaning actually, like you also said, that it prevents the use of those funds for fractional reserve banking. But it also has the consequence that the amount of interest or yield that you can get on that money will be relatively limited. So I expect that stablecoins will be more used for doing actual payments and transfers than depositing money for a longer term and keeping it there, because I expect that the amount of interest or yield that you will get on stablecoins will be limited because of the regulation that sits behind it. So therefore, I still believe that those deposits will still go to commercial banks that can still use it based on the fractional reserve bank principles and so on to make a better return on those deposits.
Okay, I hear that's a good case. Becky, did you have anything to add?
Well, I was just going to say, again, a tokenized deposit can be burned at the minute it's spent. And so it's no different than that dollar being spent and going to the merchant. So that really doesn't affect the liquidity of the financial institution any differently than a deposit leaving does. I think that both RJ and Larry mentioned the fractional reserve banking, and if you have a non-bank issuer, they have to put those deposits somewhere, right? So we have a business account that we put in a financial circle deposits or at BNY Mellon. Okay, BNY Mellon lends those deposits out or they invest them. Okay, that's what happens. And so he talked about U.S. Treasuries. Certainly that helps the United States government, right? So it's just a different way of thinking about it, but at the end of the day, it's really not that different.
Well, okay, guys, we are at time, and this has been an amazing discussion. I really appreciate your time. And just so for you guys who attended this call, like I record this, I just do my little minor editing. I don't do any major editing or anything. I'm not that skilled. But when I will try to have, like within a week, I'll make this available on my YouTube channel. So my YouTube channel is at instantpayementsmaven.com. So feel free to reach out to us with any of us with questions around this topic. And just again, thank you guys. This has just been an amazing discussion, and thank you guys all for your active participation. And keep an eye out for my next one, which will be in about a month. I think it's like the August 13th. So I have some more stuff on like instant payments and B2B, B2P payments. So yes, look for that. Have a good one.